are making an analysis of a balance sheet of a business, but they are in different industries. And so let's say in an industry, you have a really high revenue, but it's very common in that industry to have a really high percentage cost of goods sold. And then if you go in a different industry and you don't have anything, you don't have any cost of goods sold, you might be something like Amazon. I mean, how can you compare those businesses? You can't. And even if you're going to compare that same business, but throughout a 5 years period of time. So it might be a little bit hard to put things into perspective. So when you do the common size balance sheet, you're going to assume that total assets equals 100%. So right here, see? So your total assets is 100%. Everything else will be a percentage of that amount. So let's say here that this business here has $3 billion in total assets. So $3 billion equals 100%. They have 84 million in cash. So I divide 84 divided by 3 million and I see it, that's 2.5%. And then you keep doing that for everything else. So you also take 100% for total liability and equity, the right side of the balance sheet. And then you're going to assign percentage values to each line of your balance sheet. Now you have something that's a very good tool to make analysis. So let's say here, we love to look at cash, right? So let's look at our cash. In 2016, I had 2.5% of cash. And in 2017, I had 2.7%. So that's great. So my percentage of cash is actually going up. Now, let me just go ahead and tell you something here, that you do want to have cash, but you also don't want to have too much. Why don't you want to have too much cash? Why do you think you don't want to have too much? Could having too much cash be a problem? And the answer is yes. And that was actually Apple's problem. And you see just in a little bit that if you have too much cash and you're not putting that cash into use, so that cash becomes a inefficiency that will hurt your ratios and you will hurt your performance. So you want to have a cushion for sure, but you don't want to have so much cash that's just sitting there that is actually hurting your performance. And that actually happened with Apple a few years ago, and the investors were really demanding Apple to either give them back the cash or make some good use of that cash. And at that moment, you say, when am I going to make a good use of cash? And that's when you start doing your capital budgeting, right? That's when you start to choose the projects that you should invest your money in. And we have an amazing case coming up about that decision, which is the cornerstone of financial management, that is increase shareholder value, increase firm's value. And that has everything to do with choosing the projects that will increase your net present value or your NPV. Okay, so this is your common size balance sheet. So a great tool. So we could spend some time here and start making analysis for your debt, and your equity, and on and on. And then you're going to have the same thing for your income statement. And you, as you see here, you have net income, you have sales, 2 billion, and then you make sales 100%, everything else a percentage of that. So take a look. Cost of goods sold, 58%. Wow. And then you have depreciation, 12%. And then interest, 6%. Taxes, 34%. And net income, 15%. And then you can start just making analysis, making comparison from one year to the other, from companies in different industries, and so on and so forth. And now we're going to talk about something that's very, very, very important, okay? Which is I'm going to go ahead and going straight to the point with you. And that's the point right here. I want you to know this. This is the most important equation for financial statement analysis. And I want you to understand this equation, okay? So it's called the dew point analysis. Okay, so this is how it is. It's an equation. With this one equation, you can see specifically how a given business is performing. So you are now taking all those statements and you're breaking them down in this equation, okay? So return on equity. So return on equity will mean your performance. It really means for every dollar of my own pocket, my equity that I put on this business, what is my return? So return on equity is huge. So return on equity equals my profitability times my efficiency times my leverage. So my profitability, it's my profit margin, PM. So profitability has everything to do with your profit, right? And the equation for that is your net income divided by sales. So when you divide your net income, your bottom line, by your sales, what are you doing? This is what you're doing. For every dollar that I sold, what was my ability to generate a profit out of that dollar? Okay, so that will measure very directly the manager ability to convert sales into cash. So if you think about your financial intelligence or your financial IQ, you want to make sure you're able to generate a lot of money. So you want to say your sales, you want to see growing and increasing. But number two, financial IQ, number two, if you're not able to keep your money, if you're not able to make a profit out of your money, if you're not able to translate a revenue into a profit, it really doesn't matter if you're making a lot of money. And that's your profitability, okay? And you measure your profitability by dividing your net income for your sales. The second thing you want to look at is your efficiencies. So efficiencies is measured by total asset turnover, TAT. And it's a measure of the firm's assets use and its efficiency. How well does he manage the assets? So the equation is you divide your sales, you're gonna see that in your income statement, right? And your assets, you're gonna see that in your balance sheet. Your net income, it's the bottom line of your income statement, and your sales is the first line of your income statement. Just recap. So sales, income statement, assets, balance sheet. You divide your sales by your assets, and then this is the idea for your efficiency. For every dollar that I invest into this business, that I bought a factory, that I bought computers, that I bought desks, how much sales could I generate? So every dollar that I put here, how many dollars was I able to generate in sales? So it will measure your efficiency, okay? So efficiency is everything. Now, if you would stop this equation right here, and you have profit margin times asset turnover, that's return on assets, okay, which is not there. But then if you increase the next component of the equation, then you have return on equity. So FYI. Okay, so let me stop here for a moment to make an analysis for your return on assets, just looking at your profitability and your efficiencies ratios. And let me just talk to you a little bit about a given company. So let's take a quick analysis of BMW. Do you think BMW is very profitable, very efficient, or both? What about Walmart? Do you think Walmart is very profitable, is very efficient, or both? Now, the answer is Walmart is actually not very profitable. Why? Their revenue, their sales, it's very close to the cost of goods sold because they actually sell pretty cheap. So they make money on the volume of sales. So they are extremely efficient, because for every given dollar that they invest, they're generating a lot of sales, but they're not very profitable because the net income percentage of sales is not amazing. So then you start seeing the strategy of a company. So Walmart, it's not a premium business, but it's a business that's making money as they scale things up. And you can see this in this equation. Now, if you take a look at BMW, they're not selling a lot of BMWs as if you would compare it to some other vehicles. But when you buy a BMW, you got to pay $50,000 and up, $100,000, $200,000. So they're making a good profit. The relationship between net income and sales is significantly better than Walmart. So you can see that a company might be making trade-off. They might be choosing to be profitable at the expense of being efficient. And you might be thinking, is it possible to do both? It's possible. It's very difficult. But there are some companies that have done a quite good job with that. Toyota is a good example. They're able to have some profit, some much better profitability, nothing like those premium brands, and they're still very efficient. Now, we're going to add the third component of this equation, which is your equity multiplier. Okay, so what is an equity multiplier? Now, your return on assets, which is PM times TAT, will measure your profitability and will measure your efficiency, and that's it. So you really would see how well you're performing. Now, if I can multiply my return on assets using somebody else's money, wouldn't that be good? Yeah, that would be great. So what that means is that instead of having $1 of assets, I'm going to have maybe $2. And if I have $2 as assets, that means my profitability also, I'm going to multiply my equation. Okay? So that's the equity multiplier, and that's a measure of how much debt you have. And remember that this debt is not being used for a bad purpose. It's being used to multiply the performance of your business. So that's amazing, right? So if you have an equity multiplier of 2, that means all of that results, the good results that you're having, you're multiplying that. That's exactly right, correct, financially correct. Now, the equity multiplier also is a measure of risk. Why is that? Well, the more debt that you have, the more risk you have. Why? Because if you, for whatever reason, your revenue goes down, you still have those fixed payments, right? Just talked to you about that. So there is a optimal capital structure, which is the mix between equity and debt. We're not going to talk to you about this, but you don't want to have too much, and also you don't want to have too little, depending on your strategy. You might come from a background, I have many friends, I've seen many companies that they're like, we have zero debt, and that's fine. And you might go to another background where are some people that are using really bad use of fire, which is debt, and they're getting burnt. But you might have a group of people that enjoy to have a fireplace that says, I can use debt, it can warm me up, it can multiply my income, but I'm just going to make sure I do it properly. So the equity multiplier will multiply your performance. So if you are performing poorly, let's just say that your results at the end of the year are negative, your equity multiplier will multiply your bad results as well. So you work for both sides. So you can have your performance multiply or your underperformance be multiplied. So very, very, very dangerous. And at the same time can have a tremendous financial purpose. Okay, so with that, I just explained to you the most important ways you can perform a financial statement analysis of a company. So as you're making your financial statement analysis in your case, please let me know, what is the return on equity? What is the return on assets? What's Talk to me about the profitability. Talk to me about their efficiency. What about their capital structure? Okay. So that's the most important thing. Is that all? No, that's not all. So this is all right here. That's all the ratios. And they're all breaking down here for you. That's all in your book. And let me talk to you about some important ratios. Liquidity is a very important one because liquidity has to do, I mean, am I going to be able to pay my bills in the next year? And I'm a big fan of cash for that. So I would take a look at your cash ratios, but also the current ratio is good, which is your current assets divided by your current liability. So you want to have a liquidity analysis, very important. Also, the market value ratios are very good because as I explained to you in the previous video, your financial statements, they're using GAAP, and sometimes they can be based on historical values, and the market values might actually go in somewhere else. That's again why I'm a really big guy of taking a look at your cash flow analysis, even projections into the future. But those market value ratios here would be also they'll give you some really good insights about the business. So you can incorporate this equation here, and you can also have your solvency, liquidity ratio analysis, and your market analysis, and you will have a very good, thorough analysis of any given business. Thank you so much for your time. Please let me know how this course is going for you, and I hope you have fun working your case. Feel free to reach out to me by email or my phone number anytime with any questions. Thank you very much and have a great week.